Good morning, everyone. I am Pipul Kumar N.M., Assistant Professor of Commerce, Kursi Jayanti College, Bangalore. I'm going to introduce a subject called Accounting for Non-Accounting Executives. Course details. The course title is Accounting for Non-Accounting Executives. It's an open elective course. The course code is 21COM 3T311. It's a 3-credit course. 30 hours is allotted for the subject. The internet level is certificate. The cross-cutting issue addressed is professional ethics, and the needs catered by the course is national level. Course objectives and outcome. After completing this subject, students will be able to understand the basics of accounting. They can understand the transactions and company annual report, etc. The course is classified into 5 units. Unit 1, Introduction to Accounting. Unit 2, Transactions and Recording of Transactions. Unit 3, Preparation of Financial Statements. Unit 4, Company Accounts. Unit 5, Management Reports. Unit 1, Introduction to Accounting. Accounting is a very familiar term among people. They are always using the term accounting, accounts, accountancy, etc. What is the exact meaning of accounting? Accounting is the process of recording financial transactions pertaining to a business. The accounting process includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. The financial statement used in an accounting are concise summary of financial transactions over an accounting period, summarizing a company's operation, financial position, and cash flows. The simple meaning of accounting is it's a language used by a business organization to express their operations for a certain period of time to the stakeholders. Definition of accounting. The American Institute of Certified Public Accountants had defined accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of financial character and interpreting the results thereof. This is an elaborate definition given by American Institute of Certified Public Accountant. And by looking into this definition, we can understand the real importance of accounting. It's not just preparation of books of accounts. It includes recording, classifying, summarizing in a significant manner and in terms of money. Any transaction which can be considered as a monetary transaction will be taken for preparing the books of accounts. So that is the interpretation of this definition. Objectives of accounting. There are 7 objectives given here. From the first objective, recording business transactions systematically, determine profit and or loss incurred, ascertaining financial position of the firm, assisting management, assessing the progress of business, detecting and preventing frauds and errors, communicating accounting information to various users. These are the objectives of accounting. First one is recording business transactions systematically. It is necessary to maintain systematic record for a business transaction as it is beyond the human capability to remember such a large number of transactions and events. The chances of skipping the transactions and events are very high. In order to avoid that, we should have a system for recording the business transactions and events for a certain period of time. The second objective is determining the profit earned or loss incurred. In order to determine the net results at the end of the accounting period, we need to calculate profit or loss. For this purpose, we need a system which should provide the information for understanding the profit or loss earned by the company for the accounting period. We have to prepare the financial statements like income statement, position statement, so that we can understand whether the company is in profit or loss for the previous year. Third objective is ascertaining the financial position of the firm. There are two concepts you should remember on the financial position of the firm. The first thing is the preparation of income statement. After preparing income statement, we will be able to understand the operational results of the organization, whether the company is in profit or loss. While preparing balance sheet or the position statement, we can understand what all assets owned by the organization and liabilities owed by the organization towards the outsiders. So, accounting objective is ascertaining the financial position of the firm. The fourth objective is assisting management. The systematic accounting helps the management in effective decision making, efficient control on cash management policies, preparing budget and forecasting. Management want to take decision based on the financial results and the financial statements. They should understand the financial statement. They should interpret the financial statement so that they can take adequate decision to the organization. In order to do that, the accounting assists the management in taking decisions. Without the accounting information, the decision made by the management will not be right. So, financial accounting or accounting helps the management in decision making. The fifth objective is assessing the progress of the business. Accounting helps in assessing the progress of the business from year to year, and accounting facilitates the comparison of both inter-firm as well as intra-firm comparison. The progress of the business can be understood by evaluating the financial statements like income statement and position statement. Not only these two statements, we will be preparing other statements like cash flow statement, then fund flow statement, comparison statements, etc. So by analyzing these financial statements, the company can understand whether they are progressing or they are going in the wrong direction. And they can also understand whether the company's internal activities are strong enough to meet the demand, or the external activities of the company is very relevant for competing with their competitors. So the fifth objective is assisting the progress of the business. The sixth objective is detecting and preventing frauds and errors. While preparing financial account, the chances of detecting frauds and errors are high. In order to avoid the frauds and errors on books of accounts, there are many mechanisms implemented by organization. And if the results provided by the accounting is wrong or is not fair, it will have a huge impact to the stakeholders. So that is why detecting and preventing frauds and errors is one of the objective of accounting. The next objective is communicating accounting information to various users. We know that the company is ought to provide many information to the public, not only the public, to the stakeholders. There are various stakeholders in an organization like creditors, suppliers, customers, government, then other intermediaries who are part of the organization. So it is the responsibility of the organization to provide the accounting information on time. So how they are going to provide accounting information is through annual financial statement or annual reports. So in the annual report, we can identify various financial statements, various information related to the organization, etc. So that helpful for them to take their own decision whether they should continue the relation with the company or not, whether they should charge more taxes, or whether the investors want to move from this company to another company, etc. So that is why communicating accounting information to the various stakeholders is another objective of accounting. The next topic is relevance of accounting. So far, we were discussing about the objectives. The next topic is relevance or importance of accounting. The importance of accounting has classified into two perspectives. One is to the business organization, to an individual's perspective. First one is relevance to a business organization. How accounting will be relevant to a business organization? The first one is manage cash flow. Second is manage cost. Third is health status. Fourth one, red flags. Fifth one is empowers you. And last one is evolve and improve. First point, manage cash flows. To manage your cash flow, to manage your cash, you need to keep track of your money, incoming and outgoing. It is only when you have a grasp of the cash flow in your business that you can plan and strategize well. So managing cash flow can be understood by preparing a statement called cash flow statement. The inflow of cash, the outflow of cash can be identified easily by preparing a cash flow statement. And that helps the management to take decision and manage the cash in a better way. The second relevance is manage cost. So cost means the expenditure incurred by the organization for producing the product or providing the service. It can be fixed cost, it can be variable cost or semi-variable or semi-fixed cost. A cost accounting plays a vital role in fixing the cost of the product. So cost accounting is a branch of accounting and that focuses on how to reduce the cost and how to use the resources properly to reduce the overall cost. The third relevance is health status. Accounting reports give you a clear report on different aspects of the health of your business. Health of the business in the sense like whether the company's financial status or position or their activities are in the right direction or not. When you are analyzing the financial statement, we can understand the health status of the business. Next relevant aspect is red flags. Accounting reports make it easier to detect any fraud, embezzlement, or theft within the company. An accounting system inbuilt checks and balances make it easy for you to detect any wrongdoing within the company or the suppliers and customers. So red flag in the sense like there are certain measures taken by organization to ensure the accounting informations are error-free, fraudless, and it is fair. The things like internal check, internal audit, etc. By doing internal check and internal audit, we will be able to understand whether any problems are there in the organization, especially with regard to the books of accounts. So that point is red flag. The next one is empowers you. When you are analyzing the financial statement or when you are understanding more about the financial statement, it actually helps you to understand where you are standing, where you want to go, how you can attain your results, or how you can reach your goals, etc. It actually empowers you by understanding more about the strength, weaknesses, opportunities, and threats of the organization. The next relevant aspect is evolve and improve. So time spent porting over your financial records will show you where your business is doing well and also where is room for improvement. Every time company have to think about the improvement and evolution. From time to time, company have to change their product design, product packaging, customers, etc. In order to understand the actual taste and preference of our customers, we should thoroughly watch the market. We should understand what their requirement. We need to conduct various studies, etc. Accounting is also used as a medium for understanding all these aspects. So far, we were discussing about the relevance of accounting to a business organization or the business organization's perspective. Next is individual's perspective or the individual organization's perspective. So these are the relevant aspects. First one is budgeting. Second is spending. Third one is investment. Fourth one is taxes, and last one is savings money. Budgeting. Setting a budget is one of the first and most important steps that any accountant does for the client for themselves. To set a budget properly, you need to carefully analyze your income, fixed expenses, and existing liquid assets. Once you have done that, you can see how those numbers line up with your financial goals. Budget is nothing but the preparation of probable expenditure and probable income for a period of time. It is a responsibility of the organization to prepare budget for the financial year to understand what all incomes they can expect and what all expenditures they have to incur in the future. That is what budgeting. Second is spending. Budgeting well means balancing spending with income and making sure leave money left over in case of any emergency or saving should not unexpected emergencies occur. We have to spend money for meeting our day-to-day requirement and long-term requirement, but at the same times we have to keep some amount of money as liquid. Otherwise, it will affect the working capital requirement of the organization. Third point is investment. The concept of appreciation is essential for investing money. Concepts like the time value of money and the decent grasp of accounting principles can set you up to make wise investment for your future. Investment decision, one of the important aspect for every business organization. If they have sufficient amount of money in hand, they should invest into some potential and profitable investment avenues. But at the same time, they should ensure the liquidity of the company also. The liquidity and the profitability both are going in the opposite direction. If you are keeping more priority to liquidity, it will have an impact to profitability. And if you are focusing more on profitability, that will affect your liquidity. So these 2 points we have to consider while taking investment decision. The next point is taxes. A common interaction that most people have with accounting is during tax season. If you have kept up with tracking your expenses and income throughout the year, tax season will be easier. We know that the tax system prevailing in India is much complicated. While preparing the taxes or even while preparing the books of accounts, the identification of tax amount is a huge Herculean task. In order to avoid these kind of instances, we should plan for taxes. We try to pay the taxes in advance by understanding our expenditure and income. The next point is saving money. Saving money is essential for building a budget that enable you to hit your goals and supplement spending, saving, and investing. Every company have to save some amount of money for their future requirement that help them to meet the unforeseen contingencies, etc. And some occasion they'll get opportunity to buy the materials at a very lower rate if it is available in the market. So those kind of opportunities can be used if you have sufficient money in your hand. That's it. Thank you. This is the end of the session. We will discuss the next topic on the next class.